Good afternoon, everyone. Thank you for joining us for Financial Fridays for Ask Me Anything. Today's our topic is looking at building and managing credit. And I know we're going to open up the first 5 minutes to have some questions from last month's topic, which is on investments. So I want to pass the mic over to Max, who's going to be leading our conversation for today.
Hello, everybody, and thank you for joining us today. I want to also take a moment to say good afternoon to a couple of my team members that are here with us. We have Yumika Jones, who works with me on the New Roots Credit Partnership out of the Indianola office, and attorney Charity Bruce, who works on expungements, as well as works in the Hinds County Justice Court Navigator program. So we are excited to kick off today's Financial Friday by returning to last week's questions revolving investments. I have a slide on this actually that let me go ahead and click through. So a couple of questions that we had from last week that carried over were whether dealing with one, what's the pattern that someone should follow in life as they age when it comes time to investments, and then also what are some ways to safely invest or to kind of mitigate your risk involved. And so the answer to all of these things, I would say, is diversify investments. And I want to be clear on what that means and what that doesn't mean. What that means is, all right, let's start with what it doesn't mean. What that doesn't mean is, looking at, the stock market, for example, and saying that you want to buy stock in, a Pepsi company and a chair making company, and so because those are all different types of objects. That is one form of diversity in investments. But when we're talking about diversity in the realm of true diversity of your investments, we're looking at how your assets, the actual money that you have, and the wealth that you have, how that's spread across a couple of different key areas. One being stocks, another being the debt that you owe, and the other being cash that you have. So stocks, that is kind of the classic example. So you want to have a balance of all these. I provided on the right hand side of the screen. It's just a neat graphic that I found. You don't need to follow this to a T, but typically most folks, and also I will say, I'm speaking as someone who I think I have like $500 in stocks that I bought when I was like in college and I got really into it. So I am not telling you this as a stock market connoisseur, but rather someone who studies this kind of stuff and advises folks on how to do it. So, first of all, I would say if you don't have investments yet, this is a great opportunity to start small and to start correctly. And so you're going to want to have a mixture of stocks. So think about, there are some mutual funds. What that is it's basically, you can buy into, it's one big network of stocks, a whole bunch of different kinds of stuff. I mean, it could be hundreds or thousands of different companies that all the stock is pooled together, and it's made available to individuals like ourselves to buy a fraction of that. So then that way, when the collective amount of stocks increase, then you get, and let's say it makes $1,000 and you own, 1% of that, then you would get $10 from that. So that's another way of looking at that. That's a mutual fund. That is diversity within the stock market itself. Beyond that, though, if you have debt securities, we're not really going to spend a whole lot of time talking about that here. If you have questions, you can get in touch with me individually, but that is going to involve a whole other box of bananas, so to speak. Cash is the other one. If you have, some people want all cash, and cash can be a valuable thing to have. I'm not talking about, like sticking in your mattress and having tens of thousands of dollars of it, but within a reasonable limit, having cash set aside, whether that's in the bank or in a secure, because it can earn a little bit of interest in the bank, and it's secured up to $250,000 for each account. That's from the federal government. So I think we all learned about the Great Depression and about, runs on the bank back in the 30s. All that was when everybody basically, because banks use your money to make out loans to other community members. And so the bank isn't always going to have the exact amount of money as people have actually saved in there. And but when everybody goes to request that money at once, that's when you have a run on a bank, and the bank doesn't have enough money to pay it out. So each account that a person has with a bank is insured up to $250,000. So that's another thing to consider, is that you can stash a lot of safe money in the bank that will gain interest. You're not at risk of losing it. And so that's why that can really be sort of the core of sort of the foundational level. And then from that, and then, that you can build on that. And that's when debt securities and stocks come in. Generally speaking, the risks are reduced when you diversify, and that just makes sense. I'm sure you all hear about bad days on Wall Street for X company, or a bad day for Y company the next day. If you like a mutual fund, for example, which has hundreds, in some situations thousands of different stocks from different companies, just because one has a bad day doesn't mean that you're going to lose money that day, because there's a bunch of other ones that are making money. So that is, generally speaking, what I had about investments. Maya, feel pretty good for us to transition into the credit. Excellent. So let's go ahead and talk about building and managing credit. So the first thing I want to talk about is why credit is important. It is sort of not universal, because it's in our country, but within the realm of the United States, it is basically a universal language for how people can express their trustworthiness when it comes to taking out loans and paying loans back. At a very basic level, that's what it is. It is a way for, and we'll talk about what credit scores are, but it's a way for anybody that is going to offer you a loan for a car or for a house or a bank loan, or turn on your utilities without a deposit, or signing a lease to rent an apartment, so for example. All of those people rely on credit scores to determine what your history of paying back loans looks like, and therefore make a judgment about your trustworthiness when it comes to money. Having credit opens up the door to all of these other areas. I know that someone who has never had a credit card or never had an account in their name also means that you've never had a late payment, and you've never had an account go into delinquency. And so you might think, well, that person, that shows that they have great credit because they don't actually have any bad stuff on their record. That's just one part of the puzzle. The other part is demonstrating a positive record of financial trustworthiness. And that is really, that comes to how you can grow your credit. It's an active activity. It's not passive. You can't just sit there and let your credit grow. You have to take certain steps. The biggest one, and that's why it's in all capital letters, I actually put it 2 times on the screen. It is on-time payments. I've told this story to countless groups of folks in Mississippi when I've been doing some credit consultations, as well as generally, sharing my stories on. We do a radio show Tuesday mornings on WNPR. And I've talked about my own history with delinquent accounts from when I was in college, and then when I was fresh out of college. And some situations I genuinely did not have cash to pay the bill, for example, whether it was a medical bill that I had that was like $350, and I didn't pay it, and ended up going to collections, that's one step beyond delinquency. That's when a company's actually sold your debt to an agency, or generally it's like a law firm, that will take you to court or go after you to try to get that money back. And so I have been in a position where I've had to rebuild my credit, and I mean, it's a slow road, but the strongest way to do it is on-time payments. It's never too late to start building your credit score. And again, the way that you do that is by avoiding delinquency and staying out of default with your loans. You can also do some positive actions. And by that, I mean, one would be taking out a small dollar loan and then paying it back on time. And that doesn't necessarily mean taking out a loan today for $500 and then this afternoon giving back the $500 to the bank. That does not establish good credit. what you need to do is you need to actually take out that loan and pay it back over time. It's going to cost you some money in interest, but what's important for the credit agencies, and we'll talk about who those people are in a second. It's important for them to see a track record of consistency in payments, and that involves, monthly payments, taking out that loan and spreading it over a period of months to pay that back. And then another way to grow it is to open up a credit card. We'll talk more about credit cards in a moment, but credit cards can be a tool. They can also be a dagger, but they can be a tool for people when it comes to building credit. But again, always pay it back on time. That's the big thing, paying it back on time. So let's talk about credit cards. They really are a balancing act in the sense that they can really help you a lot, but they also, I actually personally can speak to this. I had to use my credit card primarily during the summer of 2021 for a variety of reasons. And my wife and I just had a mini celebration because we're back, back to where we were August of 2021. This was in March when we finally got back to that level point. And so it is something, you can do that, you can use credit cards when you need them, but the most important and crucial thing is that you pay back that card. And the way that you do that is by not doing minimum payments. If you only do so, for folks who do not have credit cards, what minimum payments are is, let's say that you have a MasterCard and you have a $6,000 credit limit, let's say, and you have $1,000 that you owe. They're not going to require you to pay the whole $1,000 each month. Instead, they're going to say that you have an absolute minimum. So maybe it'll be like $30 or $45. You can already see where this is going, because there's no way that paying $30 or $45 is going to get you anywhere near where you need to be to pay back the full $1,000 that you owe. But the credit card MasterCard will say, just pay us $30 or $45 this month, and you can roll over the balance the next month. But we're going to charge you interest on it, and it's probably going to be about 20% or something like that. Which really, that could be about $200 of interest, that you pay on that month. It gets compounded, and so don't pay the minimum. It is a swamp. It's a quicksand swamp that's designed to get you stuck in minimum cycles, because that interest that you then owe for that month, that gets carried over to the next month. And so instead of owing $1,000, you owe $1,200 or something like that. So and then if you don't pay, and then you just pay the minimum on that, then guess what? You're going to owe another, instead of $1,200 next month, it'll be $1,400, and on and on and on. So don't pay the minimum, and limit the number of cards that you have. I don't recommend that folks have like a set number, but definitely don't take out, I wouldn't have more than like 4 or 5 open credit cards. That's a lot. And I would have more than one. I would have at least 2 just for backup issues and things like that. So, and this is different than a debit card. I'm talking about a card that is not linked to your savings account or your checking account. This is something completely separate. But here is a tip. This is something I love to talk about. I call it the credit card two-step process that helps build your credit. Number one, step one is that you use your credit card to set up automatic payments for your recurring monthly charges. So that can be everything from cable and internet, your phone bill, if you're allowed to pay your rent or your mortgage by credit card, that would, I'd put that on there too. Anything that's going to be that on-time monthly payment, that's going to help you if you put it on your credit card, and that can be done hands-free, so you don't have to think about it. And that truly is like a passive way of growing your credit, because you are going to have all of your monthly bills will be covered on time through this credit card. That reduces you to only having one monthly payment, and that's through your credit card. But here is the catch. You have to make sure that you pay that credit card payment in full every month. Just because you are, I see a lot of folks that'll say, oh, and I'm guilty of this as well. Oh, it's an $80 telephone bill that I've always paid on time and had no problem paying in cash for. But now I'm going to go ahead and transfer that onto automatic payments, put it on my credit card. instead of paying the $80, that frees me up. I don't feel like I really have to pay the $80 phone bill this month. So maybe I'll just put 40 on that and then I'll pay the other 40 next month. Again, you still have that next month of $80, plus now you have a debt of $40 that you're going to have to pay. That builds up. So the crucial thing about the credit card two-step is that you still end up paying the same amount of money at the end of the month that you would have otherwise. Talk about managing credit. And this is really all going to have to deal with your credit score. So this is when I talk about the universal language of trustworthiness, of economic trustworthiness. That's what a credit score is. It's a way for someone to determine with just a cold, raw number how trustworthy you are when it comes to economics. There's a couple different agencies, FICO and Experian, and honestly, they might even be like the same at this point. I'm not sure, but those are the two names that you hear a lot of. Also, a lot of banks will provide you as one of the benefits. So I have Bank of America, for example. They don't have any branches in Jackson, or I think even in the state of Mississippi. I have to do banking in Memphis. It's a real pain in the neck. But they provide me once, and I'm sure other banks would do that. I also, Hope Credit Union does my mortgage. And so I imagine people can probably hack my accounts very easily now that I've told you all where my stuff's located. But there's nothing really to hack there anyways, unless you want to pay my mortgage for me. But I would say for folks that have a bank account, check with your bank to see if they can provide you with a FICO credit score every month. That would be something that's called a soft pull, not a hard pull. And what that means is pulling is like pulling your credit score. And there are two different ways. So every time that if you were to go to take out an actual loan or a mortgage, the company's going to take a hard pull. That means they're going to actually contact the credit agency, FICO or Experian, and they're going to formally request your financial history and your full credit score. And every time that happens, that a hard pull happens, that is actually going to reduce your credit score a little bit. It's kind of weird. I don't really understand conceptually why that happens, but it does. And so that's just something to keep in mind. Don't shop around for loans by doing a bunch of hard pulls. You can specify and ask banks to only do soft pulls. You can also, if you're shopping around for a car, and if you want to, figure out what your mortgage rate, what your interest rate is going to be for that loan payment, if you have to finance your car, I recommend getting one copy of your credit score, printing it out, and bringing it with you, and telling them this is what it is. Tell me if this is true and correct by the end of this process. What will my interest rate be? That way, they will not actually have to, because a car company will just say, let me go ahead and do a hard pull so I can tell you what your monthly payments are going to be with this interest rate. That's going to mess you up. You can, and they don't need that. They can use the information that you provide them to give you a rough estimate, and you can use that for the purpose of shopping around, and then wait for the end of the car buying process for once you've actually made a decision with that single company, for that one company to do a hard pull. So that way you limit the number of hard pulls that you have. On these credit reports, they will tell you what is holding you back as well, whether that is a history of delinquency or whether that is a frequent missed payments, late payments, things like that. So also take the time during these monthly if you get the monthly updates, take the time, or if you request your credit score, you can do it also from like Credit Karma or freecreditreport.com. You can request these, but again, only do it one time, because you are doing the same thing. You're doing a hard pull every time that you contact one of these credit bureaus. You're taking a hard pull, and that's going to impact your credit score. On the right, you can go ahead and see that is based on FICO, what they consider to be poor, fair, good, very good, exceptional, the different benchmarks there. I will say, that if you can get, anything above 600, you're going to be, possible to get, you're going to make your life a lot easier to get loans and to get rent, to get housing and stuff like that. So that's generally, if you're under 600, I would say the first benchmark that you should shoot for is to do anything that you can to get to 600. So pay every bill on time. I mean, really work at it. You want to have something over 600. And then beyond that, 600 is sort of like opening up the door for you to be able to get qualified for something. And then you'll probably get slapped with a really high interest rate at that point, higher than the other ones. But then after that, each of those, the yellow area, getting above the yellow area into light green, the middle green, or the dark green, your interest rate will go down at each one of those. So in other words, if you have over 600, you'll still qualify for a lot of loans or for a mortgage or whatever it is, or auto loan, auto financing. You'll just have a much higher interest rate because you're viewed as a riskier loan taker than someone who has 670, 740, or 800. Okay. And then investments, what we talked about at the beginning. So let me go ahead and pause there. We have about 8 minutes to see if, first of all, if either of my team members I missed something, if either Charity or Yamika would like to share on something, and then if not, if there are questions that we can talk about here, yeah.
There is a question, but I want to make sure I have space for Charity or Yamika to add anything.
No, I don't have anything to add.
I don't either. Great job, Max. Covered everything.
Yeah, he did. He did a great job. And the question is more so looking at a criteria for choosing a credit card, because people can get a credit card for almost any place, whether you're looking at getting it from a store or you're looking online to compare different credit card options. Do you have a criteria for what you're looking at when you're trying to choose the best credit card for you, especially if you are a beginner into actually understanding what credit is and gaining a card yourself?
Definitely. So I'll start with the beginner idea and then talk about that. So I view credit. So the first credit card that I recommend folks get is one through your bank. So that way you can you can make payments much easier. You also can actually look, all your accounts are going to be streamlined. If you have a banking app, that'll show up on there so you can see how much money you owe. I mean, it makes a credit card a lot more streamlined into whatever banking situation you're at right now. So that would be the first one. And to do that, I would actually go into your bank branch and meet with a financial advisor there, a bank, or I don't know what they call these folks, account manager or something, and ask them to walk through with you what the terms of the credit card are, so what the APR, what the interest rate is going to be for you to have to pay, what credit threshold is, what is the maximum amount of credit that you can qualify for. Chances are, if it's your first credit card, it'll be, maybe like $1,000 or $2,000. And that's great, and then you can start, building, make some purchases, pay back, within that first month, and do that, for the first year, and your credit score it'll go through the roof. And I mean that. After you've had your first credit card, though, if you're looking for something else, this is where it starts to get into the balancing act. And I start to feel a lot more like my grandma. My grandma is 94 years old. She's turning 95 in September. I'm not gonna work for that. But my grandma loves credit card benefits. I mean, and so she will, since she surfs the internet all the time. It's very risky watching my grandma on the internet because she clicks on everything that she sees, but she will keep an eye out in particular for specials or ads or deals and stuff like that, credit card deals. Things like, for example, if you take out this credit card and spend $1,000 in the first 3 months, then we will give you a $100 statement, $100 basically for your credit card. That, for people who can handle that, that's a really great, that's basically like a free $100. If you, over 3 months, if you're going to already be spending $1,000 on utilities, groceries, things that you can pay your credit card on, that's a pretty sweet deal because you're guaranteed that free $100. So that's one thing to seriously consider. But again, do that if you are already had experience with a credit card, and so you know the system of paying it off. That you don't want to just shop around and find these credit card deals, because there are infinite number of credit card deals, and they are all designed at the end of the day to have fees and to have interest rates and to really mess you over when it comes to that. So only do the credit card deal situation if you are certain that you'll be able to meet the terms and pay it off. as well. Beyond that, I'm also a really big fan. I like to get miles on credit cards. So you might want to look in if you're someone who, you know, wants to travel or go on an air vacation. And this might not even be like, if you don't have a history of air travel. This might be like you've never gone on an airplane and you really want to go on a trip in 4 months, but it's expensive and you don't want to have to worry about it. You can sign up for example, there are credit cards that are linked with airline companies like Delta or American Airlines or United, and they'll have a similar sort of a deal where it'll be like, if you get this credit card and spend $1,000 in the first 3 months, then we'll give you 50,000 miles that you can use for a trip. And oftentimes that is going to be enough to cover your trip, your round trip ticket, you know, 50,000 miles on something, or in some instances that might, depending on which airline it is, that might cover you and a partner to go. But again, that falls into the same thing that I was saying before, which is that only do those deals if you are sure that you're going to be able to pay that off and to have it not cost you anything. Because 50,000 miles is great, but it's not worth, you know, $5,000 in fees and interest and stuff that you're going to have to pay on that initial $1,000.
And I will also, if you can, and I would advise for myself or anybody, if you get an offer in the mail saying you get this credit, you're approved for up to $500 or $350, but then when you look at the print, the annual fee is $295, then you're in debt before you actually can spend anything. So they're gonna take that fee right off the top. So those types of credit cards, I would not entertain at all, because you don't want to be in debt before you can spend anything.
Absolutely. Thank you very much, Mika. I forgot all about annual fees. Credit cards should not have, for your first couple credit cards, or, you know, when you're, I mean, however, when you're early in the game, you don't need to be paying an annual fee. There is no credit card that your bank should not be charging you an annual fee for the bank. It should be zero. You hear, I think it's Samuel Jackson on Capital One, he talks about no annual fees. I mean, that's like, that there's a reason for that, because you truly you're doing the credit card company a favor by opening up an account with them. They shouldn't be charging you.
Awesome. Thank you so much. It's so much great advice. And I know the time is running down. I wanted to make sure I reinforce, if you guys have any questions still about credit, we'll still have a space open up for next month. Ask Me Anything session. Next month, we're going to be more so discussing about retirement. And I know a lot of people had questions regarding that. So please come back and listen, and also ask any questions regarding the topic. Thanks, Max, again, for leading today's discussion. It was great.
Thank you all for having us, sincerely. Really appreciate our time. I'm looking forward to next one.
Awesome.